Returning to our top story, and with the Treasurer Wayne Swan forecasting a return to surplus in 2012-13, the opposition says despite the positive spin, Australia is set for higher interest rates and the government needs to stop spending as positive signs continue to emerge for the Australian economy. A short time ago, Shadow Treasurer Joe Hockey joined me from our Melbourne studio. Joe Hockey, welcome to Lateline.
Good to be with you, Ali.
You ask how Wayne Swan can describe today's set of figures as remarkable, and yet unemployment's now expected to fall to 4.5% by 2012. Aren't there large numbers of Australians who have kept their jobs through difficult times who'll be applauding the government's budget management?
Well, I find it remarkable, to use that term that Wayne Swan used, that we do have unemployment falling to 4.5%, and yet, according to the numbers today, the budget deficit is getting larger, the Labor Party debt is getting larger, and the surplus is getting smaller in 2012 with the unemployment rate coming down.
So where would you cut?
Well, we've announced in the past 12 months almost $50 billion of cuts. $50 billion. Now, if I was in government and the opposition had offered $50 billion of savings and cuts, I'd be grabbing them. But this is a government with no ticker. And I would have thought, given that now there is an increasingly universal view amongst economists, that in order to take upward pressure off interest rates, the government should be cutting its own budget. I would have thought it would have been easy politics for Wayne Swan to pick up some of the $50 billion that we've offered in savings, but they didn't.
Well, of those $50 billion, of course, previously you've called for cuts to the public sector. Is that part of your $50 billion?
Yes, absolutely. Absolutely. We've said do not proceed with the Cash for Clunkers program. Do not proceed with the Green Car program in the same format as it is today. Pull back on the stimulus spending. We've offered all of those things, writ large, in detail, $50 billion, but this is a government that just doesn't want to do the hard yards on the budget. Let's
go back to those cuts in the public sector, though. In August, it was 12,000 jobs. Is that still the order of magnitude of cuts you'd be recommending?
Yes.
To save how much?
Well, it saves billions of dollars. I mean, we outlined a detailed list and a fully costed list. Now, the government didn't want to take it, Ali. Now, I would say to them, if you want to take upward pressure off interest rates, start cutting back on your expenditure, because we've got the Reserve Bank putting its foot on the brake by tightening monetary policy, and you've got the government with its foot on the accelerator with a massive expansion of fiscal policy. Now, it's not going to work.
That said,
it's not going to work.
That said, higher interest rates, a lot of pressure for a lot of families. You're talking about 12,000 jobs. That's a lot of jobs to go.
Well, you know what, Ali? You have to make hard decisions when you are spending more than you are receiving. You have to make hard decisions that put in place a fiscal surplus that ensures that you can start paying down the debt. Now, if you're worried about jobs, I'd say to you the government borrowing $100 million a day right now to fund its budget deficit, which is getting larger, not smaller, as each day passes, that $100 million a day that the government's borrowing, I tell you what, that at the end of the day can have an impact on small business jobs.
You say can have an impact on small business jobs, and indeed today you've actually argued that it's a recipe for higher interest rates. Now, economists would agree that government borrowing does have an impact on rates, but it's one of many factors. How direct, how big an impact do you think government borrowing has on where interest rates sit today?
Well, I think it does have an impact when there is a limited amount of capital available. Australia is a massive importer of capital, and as such, when you've got the economy running at full capacity, if you've got the government borrowing $100 million a day as a AAA rated entity in competition with small businesses out there, with home borrowers out there, it is going to put upward pressure on interest rates.
But how
much?
Doubt about that. A small impact, medium impact, big impact?
Well, it varies. It depends on the accessibility of the money.
Well, today, I guess, the National Australia Bank's business survey highlighted the extent to which Australia is a multi-speed economy, not even a two-speed economy. Is that something that the Reserve Bank should have taken greater account of before hiking interest rates last week?
Well, monetary policy is a very blunt instrument, and that's a great challenge we have at the moment. That's why fiscal policy needs to be more targeted. And that's what the government doesn't understand. It has all the levers available to it in fiscal policy to be able to deliver the direct action so necessary to get the economy on a sustainable growth pattern. But monetary policy is a blunt instrument, and the Reserve Bank would be the first to say that.
Let's look at the banks. The Australian Bankers Association, which represents all the major banks, has accused you of making, quote, false and misleading statements. They say many of your assertions about the banks are based on assumptions that the taxpayers' money is at risk. And in fact, the association says, quote, far from being underwritten by taxpayers, it's the industry itself that underwrites the deposit guarantee. A shadow treasurer should be aware of that simple fact. I'm quoting there. Your response?
Well, I'd say to Mr Munchenberg that his provocative language is not shared by the CEOs of all the major banks, and it's certainly not shared by the chairman of Bendigo and Adelaide Bank, who said recently that we need to recognise, words to the effect, we need to recognise that the banks are government-guaranteed entities and therefore are providing an essential service, an important service in the community. Now, the fact is that you can have specific financial claim schemes, you can have wholesale funding guarantees, of which the federal government, the taxpayer, guarantees over $150 billion of bank debt as of today. But the reality is there is now a moral hazard associated with the banking system in Australia. And if a financial institution fails, it is now too big to fail. And therefore, Australian taxpayers step in. Now, if there's systemic risk, and this is the key thing, this is what Mr Munchenberg does not understand. If a major bank, God forbid, collapses, do you really think that the Australian government at that stage is going to impose a levy on all the other banks at that particular moment to try and recover the sums? No.
But Joe,
and this is what Mr Munchenberg needs to understand.
Regardless of what people think, under the way that that was set up in 2008, this bank deposit guarantee, it very clearly says that the deposit guarantee will be administered by APRA. If an institution fails and APRA can't get the money from that institution, it will impose a levy on other Australian deposit-taking institutions. So the Bankers Association is correct, is it not, in saying that, in fact, it's not underwritten by taxpayers. It will be a levy on industry that will pay.
Hang on, who imposes the levy?
APRA.
Who imposes it?
APRA,
that's
according
right,
to the
government entity. A government entity. That's exactly right. A government entity imposes a levy on every other bank, which imposes it on every other bank customer.
So it's not the taxpayer, it's through the bank customer, not directly as a taxpayer. Is that the point?
The bottom line is that, and it is government action that underwrites the banks. I mean, we can argue the technicalities. I was actually there when HIH failed, and APRA said, oh, well, you just learn these lessons. Well, $630 million later of taxpayers' money and a whole lot of outrage from the community ensured that at the end of the day, Australian taxpayers are there standing by a failed financial institution.
But isn't there quite
and it alarms me, I must say, Ali, it alarms me that the chief executive of the Australian Bankers Association is starting to run a line that, oh, well, we don't really have taxpayers behind us, when in fact the reality is, of course, taxpayers now guarantee that a bank won't fail.
But isn't there rather a distinction between a taxpayer being liable versus eventually a shareholder in a bank if another bank goes down and all other financial institutions are levied? Isn't there a distinction to be made there?
Well, no, because levies are passed on to customers. And whether we like it or not, we're all customers of the banks. I mean, this is the absurdity of it. Of course government steps in. I mean, if ANZ or Westpac or Commonwealth Bank fails tomorrow, do you think the government's just going to sit back and say, OK, we're going to impose a levy on the customers of all the other banks and it's all going to be fine? Of course not. Let's be realistic here. And let's have a good look at the systemic problems in the United States and the United Kingdom. After Lehman Brothers fell over, what did the American government do? Well, it set up a TARP fund with taxpayers' money, and it went in and it became an owner of Citigroup and Fannie Mae and Freddie Mac. In the United Kingdom, they ended up owning RBS.
And of course, I guess the point is that we didn't need to do that in this country. But let's look at interest rates, because so far only the Commonwealth Bank has responded to the official hike in interest rates last week. It's virtually unheard of to have this sort of delay in the other three following suit or making their own announcement. Do you think the other banks are running scared?
Well, they may well be, but we'll wait and see. You know, if they were running scared, they wouldn't make their announcements, and they wouldn't be one single basis point above the 25 of the RBA. And of course, bear this in mind, Wayne Swan made a point of leaking to the newspapers that he had rung around the chief executives of all the other banks and said to them, do not increase interest rates above the 25 of the RBA. Well, we'll wait and see.
Well, you met with West...
I would expect that the other banks will increase by more than 25, which will be the ultimate indication of the weakness of this government.
Is that what Gail Kelly told you yesterday when you met the boss of Westpac?
No.
What did she tell you?
Well, that's between Gail Kelly and myself, but we had a very good discussion. You know what, you look at someone like Gail Kelly, who was absolutely right to say that everyone should be calm, everyone should be measured, and engage in a proper public debate. Now, the Chief Executive of National Australia Bank and a number of others have done that. However, there are some Chief Executives that have chosen to take a more public route. It was the ANZ Chief Executive that started introducing personality into this debate. Quite frankly, they will be victims of their own words.
Is that a threat?
No, it's in the eyes of the Australian people.
In this whole...
You know, that's what it's about. I mean, we're all judged by our public comments, and I would say that there are some chief executives and there are some chairmen of banks that are very engaging and very prepared to be constructive in this discussion. But there are others that perhaps because they haven't been here long in Australia don't understand that these are important public debates and that we have a right and an obligation to properly debate the future of our banking system.
In this whole debate about mortgage rates, does it need to be elevated to actually look at the structure of the industry? Because a lot's been written in recent days about the fact that Australia is one of the few countries in the world where the default home loan is actually the variable mortgage rate. For example, in the US, you do a set and forget. You set your home loan rate for the entire duration of your home loan. Is there room in this country for perhaps even to mandate that a product like that is on the table, maybe pay more for the premium, but at least the homeowner doesn't have to be able to predict interest rates, which no one seems able to do?
Look, it's a good debate to have, and you know, it's happened because we've started this debate.
But would you be in favour of that, some sort of mandating of a set and forget?
No. I am very concerned about specific product regulation. Look, the government said it was going to have bank switching accounts. That's been a failure. Only 1,800 people picked that up. The government said it was going to have first home saver accounts, allocated $1.2 billion to it. It's been a complete disaster of a program. Barely $200 million got out the door. And every time this government gets into the business of specific announcements about specific products, it goes wrong. And that's because banking and revenue for banks is like a balloon full of water. If you push at one point, there'll be a bulge somewhere else. So if you remove exit fees over here, simply the banks will just increase fees and charges somewhere else. And that's
but that's something you've been in favour of yourself, isn't it?
Well, no, I have never actually been about a specific product. I was at pains not to talk about specific products and specific product decisions by the legislature. In fact, of the 9 points I raised, not one relates to a specific product. And I had an honest discussion with Bob Brown today about his bill where he wants to get rid of ATM fees. And, you know, that sounds publicly attractive to get rid of ATM fees. But I'd say to you, the smaller banks rely heavily on exit fees. They rely heavily on other forms of fees. The bigger banks are happy to get rid of some fees.
So your argument is it's more about competition than specific products.
Exactly. I wish all your journalistic colleagues would understand that as well. But that's exactly what I'm about.
Just a final question. Tony Abbott says the banks never moved mortgage rates independently of the RBA under the Howard government. They did twice. Is it a great hindrance to you when you're trying to make an argument about the banks, but your leader gets the facts wrong?
No, because in fact, the truth is they did move, but they reduced interest rates by more or certainly didn't increase interest rates by the same
once
level.
They reduced them by less than the RBA. The second time, they hiked when the RBA held.
But on other occasions, they actually reduced their interest rates by either more than the RBA, or they certainly didn't pass on the RBA rate increase.
So he wasn't wrong?
No.
Joe Hoggy, we'll leave it there. Many thanks for talking to Lateline.
Thanks very much, Ali.